This week we are talking about the big beautiful bill. This is the $4.5 trillion tax bill that was signed into law last week on July 4th. This bill is packed with 870 pages of changes, and today I just want to break down a couple of the changes and a couple of the things that didn't change that will impact you if you are in or near retirement. Before we jump in here, if we haven't gotten to meet yet, my name is Dylan Martin. I'm a certified financial planner with Stewardship Investments, and if you haven't gotten the chance to yet, make sure you like and subscribe to stay up to date with the information that we're putting out here. We release videos every Friday with tips on retirement planning and how to be good stewards with your money, so also looking at what the Bible has to say about money. So let's jump in here. One of the big things here that didn't change that was rumored to is that the big beautiful bill did not make any changes to Social Security. There were rumors around that maybe Social Security was going to not be taxed anymore, but as the bill has come out, there was not any changes at all made to Social Security. Another thing here that didn't change, or at least the bill has now made permanent, that was subject to change, are the income tax brackets. Those income tax brackets were set to revert or sunset back to 10%, 15%, 25%, 28%, 33%, 35%, and 39.6%. But those are going to permanently stay for now at the current tax brackets, which are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Another big thing that the bill did is it increased the standard deduction. So the new standard deduction is $15,750 for single filers and $31,500 for those who are married filing jointly. And that standard deduction will now increase with inflation each year as well. Additionally, the bill has added a $6,000 personal exemption for people who are 65 and older. This is similar to a standard deduction, but it's called a personal exemption instead. And this is for people who are 65 years and older, like I said. There are income phase outs for this exemption. That income phase out for those who are filing single on their taxes starts at $75,000 and fully phases out at $175,000. And then for those who are filing as married filing jointly, your exemption begins at $150,000 and phases completely out at $250,000. Also, the SALT cap with the 2017 tax law that Trump put into place that put a cap on how much you could deduct if you itemize your taxes for state and local taxes at $10,000, but that SALT cap has been increased now to $40,000. The estate tax exemption that has been increased to $15 million per person, and that is a permanent change as well. So that's $30 million per family. And for those of you not familiar with this estate or gift tax exemption, that is the amount you are allowed over your lifetime to either gift to others above and beyond the yearly gift exemption amounts. And that is also the exemption you have when you go to pass away. If you have assets below that, there is not an estate tax on those assets. This next change here is great for those who are charitably minded. The bill has added in a permanent addition to charitable contributions if you are taking the standard deduction. So if you're taking the standard deduction, you are now able to deduct an additional $1,000 per person, so $2,000 for those who are married filing jointly, if you have given at least that much charitably. There used to be a provision that was similar for this in the years during COVID, but that had gone away, so now that is brought back and been increased a bit. So a good change here for those of you who are charitably minded and taking that standard deduction. So another thing you're able to do with taxes is when you're itemizing, you're able to deduct your mortgage interest, and the bill has put in a permanent limit on this, so you are only able to deduct mortgage interest for mortgages that are less than $750,000. This limit was originally set in that 2017 Tax Cuts and Jobs Act, and now that has been made permanent. Some additional new temporary deductions that are going to be valid from 2025 to 2028 are that on up to $25,000 of your tip income is excluded from taxes, up to $25,000 of overtime pay, and that's per married couple, is also excluded. And then another new deductible item here is up to $10,000 of car loan interest is also going to be a new thing that you are able to deduct as well. Last big thing I wanted to touch on here, and I'm sure we've all heard heard of these, but the Trump accounts for minors. So these are a new IRA type style account. There's a $5,000 contribution limit for these, and the government will add $1,000 per year for each kid into these accounts for children that were born between 2025 and 2028. So again here, this bill is 870 pages long, a lot of information. I just touched on some of the highlights that I believe are applicable to those in or near retirement. Again though, this is confusing. There's a lot of moving pieces, so if you are needing any help walking through your financial situation and how this bill is going to impact your retirement, we'd love to be a resource for you. You can check out our website below and schedule a time for us just to chat through your situation, and we'd be happy to answer any questions that you're having. Or if you're just wondering here if you're on track for retirement or not, also be sure to check out our 2-minute quiz also below in the description. Go to our website, you can take that quiz, and we will be able to give you a personalized response to that to let you know if you are doing well and on track to have a great retirement. Hope this was helpful for you guys, and we will see you next week.